we are going to go into the issuing of shares. Remember what issue is. It is selling the shares. That is how we get the share capital. Those that buy it become the shareholders, which are the owners. They receive a dividend. So these things are going to keep on coming up. So the capital of a limited liability company is divided into units called shares. Persons who invest in a company by buying shares are called shareholders. Shareholders are the owners of a company. So that is just summarizing what we have been saying before. Here we come to the types of shares, the two types of shares, the ordinary shares, also known as the common shares, and the preference shares, also known as the preferred shares. In CSEC, we tend to use ordinary shares and the preference shares. And then if you go on to Form 6 to do accounting, then you would see more commonly common shares and preferred shares. But they mean the same thing, ordinary, common, same thing, preference and preferred. So the ordinary shares are the shares that represent the normal equity of ownership in a company. It is the normal ones. All corporations would have ordinary shares, right? The ordinary, the common, that is the majority of their shares. And of course, we mentioned the word dividends. Dividends is the share of profit that the shareholders get. Preference shares, yes, they have a preference, meaning that they receive their dividends before the ordinary shareholders. However, the dividends that they received, we would see it emphasized as we do the accounting, is a fixed dividend. Okay, so the fixed, and this is an example. So when you see the name and you see preference shares, but you see that percentage in front of it, 5% preference shares, 7% preference shares, that just signifies how much dividends, their fixed dividend rate that is attached to those particular shares. So they will always get the 5% every single year, 5%. And you will see 5% of what as we move on with the accounting. So once again, we are not going to go into the big explanation and stuff. You have it there in your books. These are just some of the characteristics of the ordinary shares and the preference shares. When we are doing the accounting, the main thing, two things, preference shares, shareholders are paid or they receive their dividends before the ordinary shareholders. And two, they receive a fixed dividend rate. So theirs is fixed, whereas the ordinary shareholders can receive different returns. Some years, nothing, other years, a lot. Okay, so that is the main thing in terms of the characteristics, but you can go and you can read up on it. So share capital refers to the amount of money the owners of a company, shareholders, have invested in the business, as represented by ordinary and or preference shares. In other words, the share capital is the money a company raises by issuing or selling shares. So it's how much is invested by the shareholders. They purchase shares with money. That is the share capital. Looking at it from the business point of view, the business sells or issues shares at a certain price. The money they receive, share capital. Okay? So that is what we are going into now. And for this lesson, this is our focus. So we have had that introduction. We've called out things like dividends and debentures and stuff like that. You're not going to really hear about that for the rest of the lesson because all we are focusing on now would be shares and share capital. So issue of shares. Issue of shares is a process in which the company sells or allots shares to individuals or other companies. Shares are issued at a fixed price per share. And the fixed price per share, we'll get into that. When a company issues shares, shareholders are issued a share certificate. So just for your knowledge, very, very, very quickly, you will see this is a a share certificate, and it has number of shares issued, who it was issued to, the date it was issued, the 1st of November 2016, and the price that it was issued at. So you see the £1. So this little certificate will just give you all of that information. Of course, this is a template. It will be the name of the company issuing the shares. So the corporation, that will be here. So that is all this is a document, and it can be used as source document, how many shares were issued. So what we're going to do is we're going to start off with how do we calculate share capital. This has to be emphasized because when you're issuing shares and then you're accounting for that, you're going to have to remember this formula, okay? Have to. So share capital, as we said before, is the money a company raises by issuing or selling shares. This formula, stick it in your brain. Share capital is equal to the number of shares multiplied by what we call the par value. This is extremely important, and we're going to emphasize it more as we do the accounting. Par value. The par value is the dollar amount assigned to each share. It is the stated value or the face value. So everything, each share is going to have attached to it what we call a par value, which is different than the price that we sell the share for. So we have a company called Corp R Us, issued 10,000 ordinary shares at $1 par value. Here's the par value. So they issued how many shares? 10,000 par value. So if you have to work out the share capital, number of shares, in this case issued, number of shares issued multiplied by the par value. So that will be number of shares is 10,000, par value is $1. So that will give you share capital, and we're being very specific. Since it's ordinary shares, it's ordinary share capital. Ordinary share capital, $10,000. Next example, Corp R Us issued 10,000 5% preference shares at $1.50 par value, $1.50. Remember the formula, most important. Share capital, number of shares by par value. That does not change because you're now seeing a percentage. So this is what we need to emphasize. Remember what I said? So I'm going to call the word again just to let you know. The 5% represents the dividend rate. We are not dealing with that at all when you're issuing shares. So basically, you are going to ignore this percentage because in your formula, which you are learning off, number of shares by par value, there is no percentage in this formula. So you do the same thing. Number of shares, 10,000. Par value, $1.50. Same formula, and therefore your share capital is $15,000. Nice, easy. Once you remember, very importantly, this is the formula and it does not change. So we take another one just to emphasize. Corp R Us issued 10,000 7% preference shares at $2.50 par value. Once again, what is your formula? Share capital equal to number of shares, which is 10,000, by par value, which is $2.50. Ignore the percentage, not in the formula, so you end up with share capital, specifically preference share capital, $25,000. So what we are going to do, we don't just calculate things. We have to actually account for them by recording them in the accounting system, which would be start with your journals. And then revision, it goes to your T accounts, and then it goes to, it keeps on going through the year, journals, T accounts, journals, T accounts, and then you will do a trial balance and your adjusting entries, and then finally your final accounts, which would be your income statement and balance sheet. Right now, we are dealing with the first or original books of entry. So your journals, and we know how to calculate share capital. Now we are going to record the issue of the shares in your journal. So when shares are issued or sold, keep on reminding you what issued means. When shares are issued or sold, you debit bank because you are receiving money. Remember, when you sell anything, when you sell your stock, your inventory, is money you receive, right? Same thing with your shares. So whenever you receive money as an asset, you debit. So this is what you're going to do. You're debiting the account. How much money did you receive? It will always be how much you sold by the price. It's the same for anything, for bags, for books, for food, for anything. It is always the amount sold by the price. That is how much you receive. It doesn't change, right? So this is how you would do your working, and you debit the amount. And then share capital. Remember what share capital is. The share capital, capital credit. Before we just knew it as capital. Now we're just being more specific. It is share capital. And the formula, which remains the same, is number of shares by par value. Par value, always remember this. Okay? So how do you write it in your journals? As we said, you put your year, your date as usual. You put bank or cash. I suggest very strongly you put your working. So you put your working number of shares by the price that you issued it at, so your issue amount, and you debit that amount. It is basically how much you received. And then your share capital, you have to be specific. You can call it ordinary share capital, or you can write it like how I have it here, share capital dash ordinary shares, shorter to say ordinary share capital. So that is what we're going to be using. And the working number of shares by, of course, par value, right? You see the difference here. Issue amount, how much you sold it for, par value. Share capital, always par value. And you credit it. And these two, always, once you see issue of shares, you straight to debiting bank or cash, and then crediting share capital. Okay, so let's see, and this is the same for preference shares. It's the same thing. It's only that you're going to specify that it is preference shares, so or preference share capital. All right, if it's ordinary shares, ordinary share capital. If it is preference shares, preference share capital. So let's emphasize that or reinforce a bit with an example. On 1st of December 2019, Corp RS issued 10,000 ordinary shares at $1 par value. That was our, I think, our example before. Now we are putting it in the journal. So you have, I have it written. I should put Corp RS, haven't done that, but you understand that that is what is done. So you put Corp RS, the journal, the details, debit, credit. You see, I left out the folio for now. To 2019, that's the year, what date, 1st of December. And what you're going to do, if you remember, debit bank. They didn't tell you whether it was bank or cash, so I just use bank. Bank, working, number of shares by how much you issued it at, $1. We only have one value. So $1, that means you received $10,000. And then you go and you credit ordinary share capital, and it is number of shares by par value. 10,000. And if they ask you for a narrative, you're going to say to record issue of ordinary shares at par value. Or you can say the specific amounts, 10,000 ordinary shares at par value. Why are we saying at par value? It's because if you realize we sold it for the par value. So this is what it means by at par value. It means we just sold it at that particular price or amount, okay? So we have here preference shares, 10,000 preference shares at 150 par value. So you do the same thing, your bank, you're working 10,000 by 150, that's how much you sold it for, so that means you receive 15,000, and then you credit your share capital, preference share capital more specifically, 10,000 by the par value, which is the same 150 that you sold it for, issued it at, so 15,000. So you have 15,000 on the debit, 15,000 on the credit, and this is your preference shares at par value. What we have here is when we do not sell it at par value. You would know because usually the question would give you the issue price, so the price you issued it at, and of course the par value. If you see two different values, be alerted. It is the same two accounts in terms of you debit bank or cash with the number of shares multiplied by the issue price, how much you received. You credit share capital just like you did before in the previous examples, and the working number of shares by par value. And then because there are two different amounts, that means you would have a debit amount that is different than your credit amount. So you will know in this case, you add another account, which is called the share premium. So share premium is whenever the price that you sell it for is more than the par value. Some of you might be saying, you mean like a profit? But we don't call it profits, we call it premium in this case, okay? So we call it a premium, a share premium, and that will be the difference. Okay, so same thing for preference shares. So in this case, it will be 3 accounts. So let's do an example. We have 1st of December 2019. Corp RS issued 10,000 ordinary shares, $1 par value at $1.50. So see what I mean in terms of $1.50, two different values. So this will show you that we have a premium. So you will go and you will do the same thing every time you see issue of shares. You go through like a robot and you do this. First thing, you debit bank or cash. So you debit bank, number of shares by how much you sold it for, because that is how much you're going to receive, right? So you don't want to be a criminal and sell it for something and then put a different amount. Accountants are not criminals, right? So bank 10,000 by how much you actually sold it for, which means that you received $15,000. Okay, so your bank account will go up or increase by 15,000. Ordinary share capital, remember the formula for share capital, it does not change. It is the number of shares by par value. The par value is $1, so which means we are crediting ordinary share capital $10,000. Now you would know by now, or remember, hopefully you remember, or you know, you should know, that your debits for each transaction must be equal to your credits. So if you have your debits as 15,000 and you have your credits as 10,000, you know there is an extra account. And we know now that the extra account is called the share premium. So ordinary share premium, we're going to be specific. It's ordinary shares, so ordinary share premium. And what is the difference between 15,000 and 10,000? 5,000. If you want to get a little bit more technical or mathematical, is that a word? Anyway, basically you will look at it here. How much more is the issue price to the par value? 50 cents. So the 50 cents represents your premium per share. So if you want to find your full premium or share premium, it will be the 50 cents by the number of shares, and look, it gives you 5,000. But in the exam, you don't have to do that working. You don't have to think it out like that unless they gave you the premium or they gave it to you in a different way. Once they give you the issue and the par value, you simply just do it like this. You work out the bank, you work out your share capital, and the difference would be your share premium. Okay? So, still the 1st of December, Corp RS issued 10,000 preference shares. You see, I was nice and I left out the percentage thing for you, right? So preference shares at $1.50 par value, but they issued it at $2. So they sold it for $2, which is more than the par value of $1.50. So you go here, you do the same thing again, your debit bank. It will be number of shares by issue price in blue, which is $2, because that is how much you're going to receive, 20,000. And then your ordinary, no, it's preference shares. So preference share capital, 10,000 by 150, credit 15. You have two different amounts, so you will have a share premium difference between these. We have 5,000 again. Okay, so that is how you will do it. Once you just follow the steps, the full steps, you're good to go. Okay, so here are a few activities just to reinforce, and we're going to go through it like this because like clockwork, because it's the same thing over and over and over again. Easy one is when it is issued at par, you just have the two accounts, bank and the share capital, and you only have one value, which is the par value. So these are our three transactions. Here we have our first transaction, and we're going to prepare the journal entry. Here I have the name of the business is MegaWin. It is the journal, dates, detail, debit, credit, the date 2020, April 1st, and what happened on April 1st, 100,000 ordinary shares were issued at $1 par value. So bank, you're working number of shares by how much you sold it for, $1, 100,000. Then you go credit, ordinary share capital, working 100,000 by par value, which is the same value. So you credit 100,000. That's it. So it's really nice and easy when it is just at par value. Okay. Next transaction, well, kind of boring in a way, you know, not really that challenging. You go bank again, bank, how many shares? 30,000. How much did you sell it for? $2. Notice you ignore the 5%. 60,000 is how much you received for selling your 30,000 shares at $2. You go to share capital, 5% preference share capital. That's the name of the share capital, of the preference shares, sorry. Working remains the same, number of shares by par value. Notice you ignore the percentage. 30%, sorry, 30,000 shares by $2. That gives you 60,000. Balanced, simple. You have just recorded your transaction. And the last one, we go again. May 31st, bank, Number of shares, 10,000 by the amount you issued it at $3. That will give you 30,000. And then you credit in the share capital, preference share capital, working 10,000 number of shares by par value. And that gives you 30,000. That's it. Nice, easy. If you still need to review it, wonderful thing. Just rewind the video and go back and you will get it again. Okay. Now we're going to go do some with the premium. Remember, same two accounts to begin with, and then the last one is the share premium. So whenever you see two values, or in other words, the issue price is more than the par value, you're going to have a third account called the share premium. So getting straight into the transaction, we have 3 transactions here, starting with on July 1st, 2020, Mega issue 10,000 $2 par value shares for $3. So you're seeing 2 different values here. Par value is $2. Issue price is $3. So you do the normal thing. You have your dates, July 1st. You start with bank. Your working is the same. How many shares by how much you sold it for? $3. So which means you received $30,000 in your bank account. Okay. Next one, share capital, preference share capital. I didn't put the 7% this time. So preference share capital. What is your working? Number of shares by par value. So it doesn't change. 10,000 shares at $2, and that will be 20,000. You see that the 2 figures differ, so which means we go to our third account, preference share premium, and the difference is $10,000. Nice, easy. Next one. On September 1st, 2020, Mega Win Limited issued 40,000 ordinary shares, $1 par value. They issued it at $1.50. So once again, you're seeing 2 different values, which means on September 1st, you do the same thing. Bank, open brackets, working, number of shares by how much you sold it at. So 40,000 multiplied by $1.50, which gives you $60,000. And then you have share capital, ordinary share capital. You're working 40,000 by par value this time. So that's 40,000. These amounts differ. So you go to the share premium, ordinary share premium, and 60,000 minus the 40,000 would be $20,000. Nice, easy. And then the last one, September 30th. Once again, 2 values. Your par value is $2 and your issue amount is $2.50. So September 30th, go to bank, open brackets, number of shares by the price of the shares, how much you sold it or issued it at, $250. So that will be $50,000. And then you have share capital, preference share capital by par value this time. So the 20,000 by par value. Notice you're totally ignoring the 5%. I hope you all got that by now. Good. And then you will have 40,000, 2 different amounts. So your share premium would be $10,000. And that is basically what you do. Once you just stick to doing it over and over and over again, then this is how you're going to get the correct answer. All right. So what we will do is we will end this lesson. So that's it for today's lesson.